Yes, so we're dealing with depreciation, the loss in the value of an asset. So we are looking at the straight line method where the depreciation expense stays the same. Okay, it doesn't change. All right, so we're going to illustrate this with an example here. Okay, company XYZ bought equipment worth 300,000, we assume on 1st January. Okay, and it has a residual value of 50,000. This residual value, also called scrap value, okay, it's also called scrap value, is how much the asset can be sold for after its useful life. After 10 years pass, this equipment can be sold for 50,000. That's what that is telling us. Okay, and they've told us it has a useful life of 10 years. Okay, so we have to calculate the depreciation account, the depreciation. We have to show what happens in the accounts and also in the financial statements. Okay, the statement of profit or loss and the balance sheet. Okay, so we're going to say year one. Okay, after the first year passes, okay, we have to calculate the depreciation. So depreciation with the straight line method is cost minus residual value over number of useful years. Okay, so the cost is 300,000 minus 50,000 over the number of useful years, which is 10 years. Okay, so 300,000 minus 50,000, that's 250,000. 250,000 divided by 10, that's 25,000. 250,000 divided by 10, that is 25,000. Okay, so this is the depreciation expense that will be incurring every year. Okay, so at the end of year one, your general entry will be like this. For depreciation, you debit the depreciation expense, 25,000. 25,000. Then you're going to credit accumulated depreciation. Remember, accumulated depreciation is a contra asset account. This, as we said, contra asset reduces the value of an asset. So remember earlier on we said depreciation is the loss in the value of the asset. So what's happening is this accumulated depreciation, as it builds, the value of the asset is going to go down. Okay, so you say accumulated depreciation, 25,000. So let me just show you what happens, especially in the accumulated depreciation account. The depreciation account, the process will just stay the same throughout, okay? But the accumulated depreciation account, let me put it somewhere here because it's going to be building up. This is a accumulated depreciation. Okay. When you do this general entry, you debit depreciation expense 25,000 here, the debit side of the depreciation expense account. Okay. Then you credit accumulated depreciation 25,000. Okay. So one is a permanent account, one is a temporal account. So this depreciation expense account is a temporal account, meaning at the end of the year you close it. How do you close it? You credit it and say to the statement of profit or loss, this PL just means to the statement of profit or loss. Credit 25,000 here. Okay. You close the depreciation expense account because it's a temporal account. Expenses and income accounts are the temporal ones. Okay, you close, you bring them back to zero, then the next year they change. Now, this accumulated depreciation account, okay, you're not going to close it. You're going to carry this balance on to the next year. Okay, so remember when you're closing these accounts, the balance carried down comes on the lower side. In this case, the debit side is zero, so it's the lower side. So you're just going to put here 25,000 on the debit side. Then the balance brought down for the next year comes here 25,000. Okay, this is year two. Okay, when we reach year two, okay, year one, we've closed it with accumulated depreciation of 25,000. So when we enter year two, the accumulated depreciation is starting at 25,000. As you are going to see once we start year two. Okay. So this is what happens to the accounts, the T accounts. Rarely will you need to show this, but I need you to see the full picture. So after we did this double entry here, we have to show what comes in the statement of profit or loss and balance sheet. So for year one, statement of profit or loss, I've labeled it. Okay, this is year one. Statement of profit or loss, you're just going to put under expenses. Under expenses, you're going to put depreciation, 25,000 kwacha. Every year, okay? Until 10 years pass. Every year in the state, year one, year two, year three, depreciation will remain the same. 25,000, 25,000, 25,000. In the balance sheet, okay, at the end of the first year, this asset has dropped in value. Okay, it has dropped. At the end of the year, it has dropped in value. So we have to find out what is the net book value basically at the end of the year. Okay, so in your balance sheet, you have cost of the asset, accumulated depreciation, and then you have net book value. Okay, so you're going to say here equipment. Its cost was 300,000. Accumulated depreciation 25,000. So 300,000 minus 25,000. 300,000 minus 25,000. 275,000. Okay. After year one, this is the worth of this asset, 275,000. Any questions before we go to year two? Year two comes, you just do the same journal entry here. Debit, depreciation, credit, accumulated depreciation. Debit depreciation, credit accumulated depreciation. Okay. The depreciation Expense account, you do the same here. After you debit, close it, take it to the statement of profit or loss. Okay. Then the accumulated depreciation account, this is what happens now. Okay. The opening balance was 25,000. Then this year again, we brought in another depreciation expense of 25,000. Okay. So the total depreciation expense 50,000. I mean the total accumulated depreciation 50,000. Okay. So the balance carried down for year 2 will be 50,000, and we transfer this 50,000 into year 3. When we say balance brought down, year 3 50,000. Okay. So when we reach year 3, that will be the opening balance. Okay. So for year 2, as I said, the statement of profit or loss, it will be the same this year. Statement of profit or loss. Okay. Say after you have added any incomes to your gross profit, then you say less expenses. We got less expenses. Then you list depreciation. Okay. 25,000 here. Then in our balance sheet, that's where the accumulated depreciation, instead of 25,000, it becomes now 50,000. 300,000 minus 50,000, you get 250,000. Excuse me. Okay. As we can see, the value of the asset is dropping. Okay. After 2 years, it's worth now 250,000. Okay. Yes. Then year 3 comes. Year 3 comes. Again, same thing. You do the general entry for depreciation, debit depreciation expense, 25,000. Credit accumulated depreciation, 25,000. So here, this accumulated depreciation account, remember, year 3, it has opened with a balance of 50,000. Now, you add in another 25,000. Okay, I've added in another 25,000. So the accumulated depreciation now is 75,000. Okay. So here, under accumulated depreciation, you're going to put 75,000. Okay, so 300,000 minus 75,000. 300,000 minus 75,000. 225,000. Okay. Yes. So colleagues, I would like